Sunday, August 4th, 2019, Maneco 64, home of alternative economics and contrarian views. I'm not doing my live stream tonight. I will be doing a video tonight about technical analysis, and I'm going to look in particular at the long-term picture for the Dow, for the S&P, and also for the Dow-Gold Ratio. And I also want to reference this book, Technical Analysis Explained by Martin Pring. I've had this book for many years. I used to use this book for work. Very good book. So I'll reference this, and I'll talk about why I think we're actually topping in the stock market. And it's been, well, almost a 2-year top now. I think we topped in beginning of last year. I know we've made new highs, but it looks like a topping formation. And before I go further, I'd like to say that tomorrow I will be making a video, but I'll probably be making it after the market closes. My wife and I are traveling early tomorrow. We're going to Switzerland for the week to see my family there. So hopefully I'll make some videos from there. A beautiful place, of course, Switzerland. So no early morning update tomorrow. I'll be traveling to the airport and I'll be flying from London to Geneva. First of all, let's have a look here at Martin Pring's book and what he says about technical analysis. This is on page 37. It's the part about the Dow Theory that I want to talk about. Before going deeper into the Dow Theory, he says, remember, technical analysis is the art of identifying trend reversals based on the weight of evidence. So there you go. It's not an exact science. We don't always get things right, but it gives you some kind of odds and indications of what is happening. So what about the Dow Theory? Part 6 here on page 38. This is what he says about the Dow Theory. And I'll read. One of the most important principles of Dow Theory is that the movement of the industrial average and the transportation average should always be considered together, i.e. the two averages must confirm each other. The need for confirming action by both averages would seem fundamentally logical, for if the market is truly a barometer of future business conditions, investors should be bidding up the prices of both companies that purchase goods and of companies that transport them in an expanding economy. Well, I know some people would argue that the stock market is manipulated, but I think they can only manipulate it so much. But let's continue here. It is not possible to have a healthy economy in which goods are being manufactured but not sold, i.e. shipped to market. So having looked at that now, let's have a look at some charts. The first chart I want to show you, I've shown this chart before months ago or maybe even a year ago. I was talking about a very big resistance in the Dow around 28,000. That was more for the beginning of this year. We haven't reached that level, as you can see here. This is a logarithmic chart of the Dow going back to 1920. You can see there the 1929 top, the crash. You can see the 2000 top there. So there's a really nice channel going upwards on this chart. And I think we're very close to the resistance there. Right now, I think it's more up around 30,000. But it's having a tough time. So I wanted to show you that chart. Logarithmic chart is a percentage change chart. So different from a linear chart. It smooths out the chart. Let's have a look now at a linear chart so you can see what I mean by smoothing out the chart. There you go. I mean, this chart looks even more of a bubble, doesn't it? We've got, you can't even see the top in 1929 is just like a little pimple there. Just before 1930, you can see the crash, the top in 2000 and the crash, and the move up towards 2008 top and that crash. And one thing I would say is that it seems to me that when we do have a crash, it's going to be much greater, in my opinion. Nominal terms, of course, percentage-wise, you never know. but it does look very bubbly. I mean, you can't look at this chart and say that the stock market is at a good level to buy. I think even someone who doesn't follow markets, who looks at this, someone who's complete novice would say, wow, this looks very, very high. Let's see if the Dow theory is working. You would have expected the transports to have made a new high this year, because both the S&P and the Dow made a new high. But as you can see, we did make a new high last year around the time that the S&P and the Dow made a high, but we failed completely this year to get even anywhere close to that all-time high. So the Dow theory here is telling us that the Dow transports is not confirming the high we had this year in the Dow Jones Industrial, and that's not a good sign. Coupled with how the charts look technically, the fact that we've made a new high recently, but we reversed and broken back below the old highs is not encouraging. Now I want to look at the Dow-Gold Ratio. And if you think about it, prior to 1933, you didn't need a Dow-Gold Ratio. The price of the Dow was in gold, because 1 ounce of gold was $20.67, and it was fixed. So measuring the Dow in gold is just going back to pre-1934. It's just like a measure of paper assets, or the Dow Industrial, in old money, so to speak. So let's have a look at the Dow-Gold Ratio, which basically is how many ounces of gold you need to buy one Dow Jones index, right? So you can see here, this is from Gold Charts R Us, and they've done a really nice chart here comparing the gold standard era up until 1913 in Europe. In the States, you could argue is 1933. But I guess he did it with when the Fed was created, and the fiat capital era. You can see how much more stable, even though there were ups and downs in that ratio in the 19th century up until 1913. But you can see since then, the swings have been quite amazing. There's been a lot of volatility. And why is that? Well, because there's so much fiat currency now about. The central banks, Federal Reserve, and all the other central banks, they create credit out of thin air with no anchor to real money or gold or silver. And that's why you get these swings. So when you get that ratio really high, as you got in 1929, as you got in 1966, and in 2000, that means that the stock market is overvalued, that real wealth as represented by gold is undervalued, and then you get a correction. And you can see that both times prior to 2000, that ratio corrected. Well, in 1933, I think it corrected down to 2. In 1980, it corrected almost down to 1. We did correct in 2011 down to around 7. And in my opinion, this is just a counter trend rally before we correct back towards 2 or 1. It could even go below 1, which will mean that 1 ounce of gold will be worth more than the Dow Jones Index. At what price is difficult to say. It's just a relative measure of value. So this is what it's about, the Dow-Gold Ratio. And I've spoken about this before, and I've said that the financial system and the monetary system will have resets once that ratio moves towards that 1 level, or even 0 or negative. That will mean that things have been rebalanced, and the economy can start again, and the system can start again. That is when you will have seen the reset, in my opinion. So let's look at some more shorter term charts to see where we are. So I've got one here. The first one, it is a long-term chart, but shorter term than 200 years. It's almost 40-year chart back to 1980. You can see there how paper assets outperform gold and commodities in general throughout the 80s and the 90s. And that ratio topped at almost 45 just before the year 2000 and dropped all the way to just below 7.5 there in 2011. And it's been trading back up. We have seen, in my opinion, a counter trend rally by paper assets. We formed the top there at 22.5, and we're building a head and shoulder formation, which is negative, which means this ratio should move back down, which means gold should outperform stocks or paper assets. So here's an even more shorter term, so you can see this head and shoulder really clearly here. This is a 3.5-year chart or so. We close around 18 on Friday, as you can see, and there's the neckline, which is around 16.5 right now. As that line is downward sloping, the neckline will move lower. But there you go. So as Martin Pring said, remember, technical analysis is the art of identifying trend reversals based on the weight of the evidence. To me, looking at the weight of the evidence, looking at the technicals, it seems to me that we could see precious metals continue to outperform paper assets and the stock market. I think the stock market looks precarious, as you saw from the linear chart. Even someone who's not even involved in markets and has never looked at markets, if you ask that person, do you think it's this looks overdone? I think anyone would say yes. So that's it for this Sunday. Hopefully I will be doing a video later on tomorrow from Switzerland and publish it for you guys. As I said, I will be traveling tomorrow morning, so I won't have time to do a video as usual in the morning. If you enjoyed this video, make sure you hit the like button, subscribe to the channel if you haven't yet, and you can also follow me on Twitter, Steemit, and on DTube. I wish you all a great rest of the weekend, and I'll talk to you later. Take care. Bye.